Many business owners are obsessed with revenue, but revenue without profit is just an expensive activity. If you ignore your margins, you could double your sales and still end up with less money in the bank. You are going to learn the cost surgery framework to remove profit drains while protecting your growth. So, let's talk about the revenue trap. Most entrepreneurs chase the next sale like it's the only thing that matters, but that is the wrong number to obsess over. If your profit margins are thin, you are just working harder to make other people rich. Think about it. A 10% increase in your margins can often have the same impact on your bank account as a 50% increase in sales. We need to perform cost surgery. This isn't about using a machete to slash everything. It's about using a scalpel to remove waste while protecting the things that actually make you money. Let me tell you about Sarah. She runs a local catering business, and last year, her sales grew by 40%. Amazing, right? Except when she looked at her bank account, she had less cash than the year before. She was so focused on booking more events that she didn't realize her food costs had soared, and she was paying for 3 different scheduling apps that all did the same thing. More customers meant more work, more stress, and less profit. She was stuck in the revenue trap, where bigger numbers on the top line were actually making her business weaker. Pause for a second. Have you ever celebrated a big sales month only to wonder where all the money went? That's the trap in action. Sarah's story is super common, but the good news is, it's fixable. To fix it, you first need to understand the numbers that truly matter. Let's break down the 3 key types of profit every business owner must know. Forget complex accounting jargon. This is simple. First, you have gross profit. This is your revenue minus the direct costs of what you sold. For Sarah's catering, that's the cost of ingredients and the wages for her kitchen staff for that specific event. Your gross margin, which is gross profit divided by revenue, tells you how profitable each individual sale is. Next is operating profit. This is what's left after you subtract all your day-to-day operational expenses, like rent, marketing, salaries for your admin team, and software subscriptions. These are the costs to keep the lights on, whether you make 1 sale or 100. Your operating margin shows the overall health and efficiency of your entire business operation. And finally, there's net profit, which is the final number after all expenses, including taxes and interest, are paid. This is the real money you get to keep. Quick question. Which of these 3 are you tracking right now? If the answer is none, don't worry. We are about to build a system for it. Now for the fun part, applying the 80/20 rule to your expenses. Most of your costs aren't created equal. We are going to categorize them into revenue generators and profit drains. Revenue generators are the expenses that directly lead to sales. Think of your Google Ads budget, your sales team's commission, or the software you use to send marketing emails. These are investments. You don't want to cut them blindly. You want to optimize them to get a better return. Are your ads converting? Is your sales team hitting its targets? These are the questions to ask. On the other side, you have profit drains. These are the silent killers of your bank account. They're the costs that add little to no value to your customers or your ability to make a sale. That unused office space, the premium software subscription you forgot about, the fancy coffee machine that no one uses. These are the first things to go under the knife in our cost surgery. Take a moment right now and think, which expense did you pay this month that added 0 value to your customers? I bet one comes to mind instantly. That's a profit drain. Identifying these is the first step to plugging the leaks in your business. Let's get specific with our first surgical procedure, the technology audit. We live in an age of software bloat. It's so easy to sign up for a free trial, put in your credit card, and completely forget about it. Before you know it, you're paying for 3 project management tools, 2 social media schedulers, and a CRM you haven't logged into for 6 months. This is low-hanging fruit for saving money. Your mission is to open up your credit card and bank statements and list every single software subscription you pay for. Once you have that list, go through it line by line and ask 3 questions. 1. What is the purpose of this tool? 2. Do we actively use it every week? And 3. Is there another tool we already pay for that can do the same job? You will be shocked by the overlaps and the ghost subscriptions you find. For example, you might be paying for a separate video hosting service when your website platform already includes it. Or you might have 3 team members who all signed up for the same design software individually. Consolidate, cancel, and downgrade. This single audit can often save you hundreds, if not thousands, of dollars a year, instantly boosting your profit. Next up is vendor renegotiation. This sounds intimidating, but it doesn't mean you have to be a tough, aggressive negotiator. It's about having a strategic conversation with your suppliers, landlords, or service providers. The key is using a method called BATNA, which stands for Best Alternative to a Negotiated Agreement. Before you even pick up the phone, you need to know what your best alternative is if you can't get a better deal. Have you researched other suppliers? Do you know what the market rate is for your office space? Doing your homework gives you quiet confidence. When you approach your vendor, don't just demand a lower price. Frame it as a partnership. You could say something like, "We've been a loyal customer for 3 years, and we want to continue this relationship. We are currently reviewing all our expenses to stay healthy, and we've found some other options. Is there any flexibility on your end, perhaps with a longer-term contract or by adjusting our service level?" This opens the door for a collaborative solution. Remember, the goal isn't to squeeze every last penny out of them. The goal is to find a fair deal that works for both of you. A 10% reduction from your top 3 vendors can have a massive impact on your bottom line without damaging important relationships. Okay, we've done the surgery, but how do we prevent the problems from coming back? You need a system. This is where the profitability dashboard comes in. All this work is wasted if you only do it once a year. You need to track these key metrics weekly so you never fly blind again. This doesn't have to be complicated. A simple spreadsheet is all you need. In it, you'll track your key numbers every single week: revenue, cost of goods sold, and gross margin. Then, list out your main operating expenses. This gives you a real-time snapshot of your business's health. When you review this dashboard every Friday, you'll spot problems before they become disasters. Did your material costs suddenly jump by 5%? You'll see it immediately and can investigate. Did a new software subscription appear? You'll catch it right away. This simple weekly habit transforms you from being a reactive business owner, constantly putting out fires, to a proactive one who is in complete control of their profitability. It's like a financial health checkup for your company. It's the system you need to stop guessing and start knowing exactly where your money is going. Thanks for watching. If you want more practical, data-driven strategies to help you keep more of what you earn, make sure to subscribe to the channel. I'll see you in the next video.